Thank you very much, everybody. It's great to be here, and I'm happy to see such a large crowd at the Money Show today. So let me say, after 30 years in the investment business, I can truly say that the investing world is never boring, and rarely more so than today. In fact, there's so much going on that we think it's really important for investors to take a moment of reflection from time to time to really look at the big picture. Because in order to successfully invest in today's environment, one first needs to understand and assess what the challenges that we as investors are facing. So in our firm, we call this our State of the Union. Now, our State of the Union is a little less formal than the one you see up there. But we like to take stock of what is going on in the world that we're facing. So clearly we're all aware about the geopolitical concerns, the political dysfunction that exists in so many places around the world, high debt levels, the likes of which we've never experienced before, a slowing growth environment, of course, the million-dollar question, which is interest rates, and finally, and always critical to any investor, investment valuations. So there could be so many cartoons on this slide when we talk about the geopolitical environment, but of course we have, at the top of the list probably, the two largest economies in the world, if not in a trade war, which they're not yet, at least doing some pretty serious saber rattling. And then various other geopolitical issues, and of course Brexit, and who the heck knows, October 30th is not very far away, and it's amazing that a place like the UK still doesn't know what's going to happen on October 30th. Political dysfunction, while not new, certainly seems to be at an elevated level. And one of the impacts is that really policymakers aren't doing very much. We're not passing a lot of things, and so there's very much gridlock out there. We're not moving forward for sure. This is really important. The combination of global government, corporate, and consumer debt as a percentage of GDP is at record high levels. And of course, when interest rates are where they are, it kind of flies under the radar. But if interest rates ever go up, this is one of the big risks that exist out there, and Canada is not immune, because in Canada, consumer debt as a percentage of income here is higher now than it was in the US just before the financial crisis. So after years of global growth, it's been one of the longest recoveries on record. We find ourselves in a situation, we're hearing about possible recession. We tell our clients, don't worry, I have the answer. I promise you there will be a recession. I just don't know when. Business cycles are what they are, and of course we're going to have recessions, but growth is starting to slow in Europe, in the US, and China, which has had decelerating growth over the last number of years, is now forecast for the first time in 2020 to have their growth level less than 6%. And for a country like China, which badly needs a lot of growth for stability to employ people, we're getting to a somewhat critical stage. So my parents bought a house in Montreal in 1955 and had a 5% long-term mortgage. And we never saw a mortgage as low as 5% again through the 60s, 70s, 80s, 90s, and 2000s until after the financial crisis. Rates were much higher. And suddenly, as people and investors and borrowers are getting very used to these incredibly low interest rates, complacent in fact, no one knows what's going to happen. In fact, in a good part of the developed world, as you undoubtedly know, rates have become negative. So there was a bank in Denmark offering a mortgage with a negative interest rate. We'll lend you $500,000 today, and you pay me back $495,000 5 years from now. And how can they do that? Because they're charging depositors to place money with them. This is the one thing that we have never experienced ever throughout history. Everything else has happened sometime before, but negative interest rates have never happened. We don't really understand the implication of negative interest rates. And lest we forget, in Canada and the US, 10-year government bonds yield less than 2%. And so investors can't make money anymore with that kind of interest rate. And this is a huge risk. If we ever get inflation in my lifetime, I'm beginning to wonder myself these days, that would cause rates to go up and cause a lot of disruption, that's for sure. And finally, we must never forget the most important thing to any long-term investor is how much am I actually paying for this investment. This is the Shiller PE. So Nobel economist, winning economist Robert Shiller said it's better to look at 10-year PEs, and the message is simply that the 10-year PE is way higher than the long-term average. But even if we look at the trailing 12-month PE of the S&P 500, it's around 22 times earnings versus a long-time average of maybe 16, which simply should give investors pause. No, it doesn't mean everything is expensive today. It should simply make us ask ourselves, if I'm a long-term investor and I'm paying a high price, then what kind of a return should I expect over the next many years? So we're, of course, in a very volatile environment, although I'll tell you, after 30 years, I've been in a few other volatile environments. And it's really important to remember that for all investors, volatility should be your friend, not something that we fear. Because volatility actually results in opportunity for the courageous investor, because, of course, it takes some courage to be able to stand in there and buying things when they're going down every day. So investors are facing this huge conundrum. For most of my career, government bond yields were 4 to 5%. Dividend yield on the S&P 500 or most other indices was around 2. So if you bought bonds, you got a higher current return. And if you bought stocks, you accepted a lower return and hoped that you had growth to make up the difference. Of course, in today's world, we live here at a moment in time where yields are lower than the inflation rate. So the only thing you're guaranteed if you buy government bonds or investment grade bonds is you're guaranteed to lose money against inflation over time. And that's true just about everywhere in the world. So here's just a long-term look at annualized rates of return of various market indices. This is the total return, so it does include dividends, all in Canadian dollars. And one thing when I look at this slide, and as one of my clients said, Lorne, the one thing I hate about investment managers is they all come to see you with a great 5-year return number and kind of lead you into thinking if you invest with them, they're going to make a whole bunch of money for you. And then you put your money with them and you end up often not doing so well. And so here we are with about 20 years worth of data. This is what it's looked like before fees. And one of the messages is, and of course, the greatest of investor, for sure, of the last 60 years, no, it is not Lorne Steinberg. It is Warren Buffett, has said that I've been telling the investment community and investors how to invest for 60 years, and no one's ever listened to me. And the reason no one's ever listened to him is because most of the investment industry asks you when you come to see them, what should your policy be? And you set a policy of stocks versus bonds. And that's the way it is forever, and you're fully invested at all times. Warren Buffett said, all of you will do so much better if you simply follow my 2 simple rules of investing. Rule number 1, don't lose money. And rule number 2, very simple, don't forget rule number 1. And of course, we all laugh at this because not only is Warren Buffett an amazing investor, an incredible, humble individual, he also has a way of taking investing concepts and making them very simple, because ultimately, investing is pretty simple. He said, as a couple of our clients who are major Canadian real estate investors have told us, Lorne, your approach to investing is very much, sorry, let me just go back here, sorry. Your approach to investing is very much like I buy real estate. Real estate is a very long-term hold. So if you're able to buy a good piece of real estate at the right price, you're going to make your money. All you do is hold it, and there you are. So entry price is critical. And as an investor, value is everything. When we look at the world today, we as investors are looking for value. So there's 3 things that we're focused on. One is, as Warren Buffett said, if nothing is cheap, you should probably hold some cash. Yes, we hold some cash. Berkshire Hathaway, by the way, is sitting with a record amount of cash, even on a percentage basis, 120 billion. We're holding a little less than that. We do see value in global equities, but only in those companies who are trading at attractive valuations, not trading at market valuations. In the fixed income world, and most clients have some kind of balance to their portfolio, the only value we see is in the high yield bond market. I truly want to thank all of you for coming here, for listening. I hope the rest of this, I know, will be a great show. I intend to watch it. And certainly, for anyone who wants to come and meet with us, we have a booth in the room over there. I will be there. We'd love to spend time with you. So thank you very, very much.